Okay, so I am going to go ahead and get started. I think that I'm now live on Facebook, but if not, like I said, I will post this at another time when once I get the recording done. So with that, I am going to go ahead and start. Tonight's session is about income statements and the basics of how to read an income statement. So with that, I'm going to go ahead and get started, share my screen, and we'll go through the training that I prepared. So with that being said, let's go ahead and get our slideshow started. And the first part of what we're doing is the profit and loss statement and financial. These are very basic financial statements, just so that you know. It is not, there are much more complex ones, but this is just a great tutorial to beginning to understand what is made up of your profit and loss statement, or you may hear it called an income statement as well. So I just wanted to give a little background for anyone who hasn't seen any of my presentations before. I do own Valid Solutions Consulting. I am the CEO and founder of the company, and I also have a group called Women's Business Strategy Network and a website, and that will be educational based business training and financial literacy training. So just to give you a little background of me, my first company I had at the age of 16. I did work in many different, several different companies once I got through the horses and the farm and everything that I was on when I was 16 through 18. And then eventually went back to college at 18 and a half, 19 years old, and discovered accounting and decided that that was something that really I liked a lot, and I knew and I understood what accounting was all about. So having worked in business a little bit, it gave me a little bit of a financial background of understanding what all those numbers meant. So with that, I pursued a bachelor's in accounting. I went ahead and did my master's degree in business. I have an MBA, and then I sat for my CPA in Florida, and I was licensed for 4 years as a CPA, and then decided that since I was working for corporate, I really didn't have the need for a CPA license, so it is now inactive. My first financial controller position was 30 years ago. I've been in about 15 different, very diverse and different companies since then. And what that does for me is it gives me the ability to say, gee, I may not have done this before, but I really have a better understanding of how businesses operate. So as a financial controller, not only in many of these companies, that I was responsible for the accounting, but a lot of the operations, human resources, acquisitions, dispositions, many different aspects of accounting I was responsible for. So I also, with that, came in, did a lot of accounting and operations system implementations. And now what I do is I have 4 or 5 clients that I do outsourced CFO and controller work for. I travel around the country in my RV with my husband. Last year we went to 20 states in 2020, and we intend on doing a similar travels this coming year. So I do everything remotely, which is awesome because we get to visit this wonderful country of ours. So with that, we'll get into the meat of what our training is about tonight. Understanding, well, what exactly does an income statement represent for your business? And what it is that the report, the income statement itself, is a cumulative report. And what that means is it measures a period of time. Instead of a point in time, it's a period of time. Generally, financial statements are run on a monthly basis, and you will find income statements that are usually run by the month, by the quarter, or by the year. And sometimes those are compared with each other. It's called a comparative financial statement. So you may look at how did you do last year versus how did you do this year, and look for some percentage changes. See if you're improving, see if you're not improving. Maybe what did you do last year that you're not doing this year? But the income statement is also your progress report. It's the report card to tell you how well you're doing right now. So we're going to go into some details as to really what is how is this statement broken down? So what is business income or revenue? Money or its equivalent. And I know that these days there is some bartering going on and some other things like that, but money or its equivalent. We've got cryptocurrencies out there too. Received in exchange for providing products or services. And that's before subtracting any costs produced to produce it, any taxes, any discounts, adjustments, or any other expenses. So that's what income is. It's also called sales, it's called revenue, it's called services. There's lots of different names depending on what industry that you're in. But there's also types of income. So there's operating versus non-operating. So I will jump down to non-operating, which is this little graphic I have here at the bottom of the page. Non-operating revenue are things like interest income from investments, any kind of income that comes in that isn't specifically generated by an operation that you do from the company, okay? So we'll jump back up here to operating. So operating are things like products, and widgets is a generic term many times you'll hear referred to as a unit of measure of something, but it's the things you make or that you buy to sell, or in fishing or farming, what you produce, what you catch, any of those types of things that you sell for a product. It's a product that you sell. You'll also have revenue generated by services, computer programming, rent on your real estate, legal and accounting services, doctors, dentists, and the list goes on. It could be gym memberships, it could be anything that is services related that isn't a tangible product would be a service. So operating revenue is what is produced in the day-to-day activities of your company. Why does your company exist? What does it provide? Whatever it provides and whatever you're exchanging for money is your revenue for your company. So now an important part of understanding that your revenue is how do you collect your money? Does your client or customer pay you for what you sell up front, and do you provide that service or product right away? This is the structure of how your income statement works. Then your business is most likely a cash-based business. It's really pretty much like your checkbook. It's the deposits of money that actually go into your account. And the reason this is important is because when we get to the bottom of your income statement, now you're going to see, well, does that really represent what kind of cash I have available? Because many times people misunderstand that profit means that's the cash you have in the bank. And that's not necessarily true, especially if you are not on a cash basis business. Even if you are on a cash basis business, it still may not necessarily represent what's on the bottom line. Does your customer or client pay for what you sell over time or on credit? And then do you provide that product right away? Well, that's an accrual-based business. What it means is you have accounts receivable. You're billing a client, you're giving them a service, and you're waiting for money to come in from that client. Now, most of the time that money may come in 30 days, but if it doesn't, or you give longer terms than 30 days, then you may have provided or sold a product or a good, but you're not getting the money for that until at a much later date. And that's going to affect what's in your bank account, of course. Then you also have, well, does your client pay you for something that you sell up front, but do you provide that product or service over time? So that could be something like, a good example is a subscription service. You may charge $50 a year for subscriptions, but they get 6 subscriptions a year. Well, you really haven't earned any of those other 5 other than the first one that you produce and give them until you actually deliver that service. So in that case, you're going to accrue the revenue on your balance sheet. And I know I'm throwing out some terms that are unusual, but it does make a difference. You don't necessarily put those expenses on your income statement because you really haven't earned them yet. And revenue is based on what you've earned. There can also be a hybrid of cash and accrual, and we'll explain that as we go along, especially when we get into things like inventory and all of the other next elements of what we're going to discuss today. And again, there are a lot more technicalities in a lot of these areas. I am trying to keep this as basic as possible to make it easy to understand very quickly. So what does that mean to you? Cash collection considerations. If you collect money up front, then your income statement, as I said before, is like deposits that come into your checkbook, and your income statement will be closer to showing you how much cash is on hand, but it's not necessarily entirely accurate. And once we cover more of this training, and one of the next sections that I will be covering, cash flow training, will reveal why profit is not necessarily cash on hand. If you bill your customers, then your income statement doesn't mean that cash is in the bank. The amount that's owed to you shows up on the balance sheet as accounts receivable, and that is an asset to you. In other words, at the bottom of the income statement, you may show a profit, but it doesn't mean that that's the cash that you have today. So this is an example showing you the differences of how this could be different for you. And I hope that this is pretty simple in explaining that. So if you have a company that's on a cash basis, they sell $10,000 worth of blue widgets and $15,000 of red widgets and $1,500 worth of services, and they sell shipping, then they're going to have $27,000 worth of income, and all that income is paid by ACHs or credit cards. People have to pay for what they get from you upfront. So they don't owe you anything. Your accounts receivable is zero. You don't have to worry about collecting anything. On the other hand, if you have the same company with the same kind of structure, but only $20,000 have come in by ACH or credit card, some of your customers or clients still owe you $7,000. That $7,000 you can collect on, and that's an asset on your balance sheet. So while the amount that is owed to you is an asset on the balance sheet, you realize that cash, that $7,000, is not available to you to pay bills or to pay payroll or to pay any other expenses. And again, a lot of times when people are looking at their P&L, as it's referred to many times, they say, hey, I made $20,000 this month, but how come I don't have, I'm short on cash? This is why, or one of the reasons why. The next area we'll get into after all the money that's come in the door is how did you generate, what did you do to create that revenue? So many times, if you have a company that is selling something tangible, a specific product, you might have some costs that go along with that. And with that, you're going to hear something called gross profit. Gross profit and that percentage is what they call a key performance indicator, or you'll hear the word KPIs a lot. So KPIs is something in your industry that you may want to look at. If you're selling a specific kind of, t-shirts or, different types of products, you may look in the industry and say, okay, what are the profit margins that other companies are making on this product? So that it gives you an idea that you're pricing your product either higher, lower, or the same as other products in the market. That also may have to deal with the quality of the product, what you buy your product for, how you manufacture or make your product if you're making it yourself. There's a lot of different factors that are involved, but it does give you an idea, especially if you're going to purchase a company. You want to look at what is their profit margin on what they're producing and how close is it to industry standards. So what is cost of goods? Cost of goods refers to expenses that are directly related to the production of the product, like materials needed to assemble it, the transportation needed to bring the goods from the distributor to the retailer, labor that is specifically tied to producing that product, so pretty much in manufacturing, any direct materials or raw materials needed in the production of the goods and services. Another good example is in rental real estate. If you're renting something out and you have to pay a commission to a broker for that rental, That's a direct cost of that rental. So that's a cost of goods. You find that you see more costs of goods in measured in respect to products. However, with the cost of services, you may have with a sale of services, you may have a cost of services. So let's say you're a software company and you have programmers, or you have consultants, or you have people that you're paying um, to provide that service. That could be a cost of services. So you may be looking at a cost of services sold and looking at a gross profit number. Same thing with, there's many other different aspects, doctors, dentists, things of that nature, that you are selling their services, but there's a cost to providing those services that are directly related specifically to what's sold that month. So that will give you an idea. Also bear in mind that in cost of goods is directly related to what you've sold. It is not everything you buy for the month that you haven't sold. That is inventory. And inventory depletion is an important part that many young and new business owners don't understand. Inventory, when it's purchased, is carried on the balance sheet as an asset. And when it's purchased and depleted, it's directly related to what's sold. So here's a great example explaining what I mean by that, and a crucial mistake that sometimes gets made that people have to bear in mind. So again, trying to explain it as easily as possible. So for example, if you have a blue widget that's $20 and it costs you $15, the gross margin's $5. So what happens sometimes is, let's say you sold 5 blue widgets, but that month you actually bought 10 blue widgets and recorded the total cost of $150. It'll look like you've lost $50 if you record that total cost of those 10 blue widgets that month. But you only sold 5 of them, so you should only record the cost of 5 of them. So now it's showing that you made $25. Well, where are those other 5 or 10 blue or 5 blue widgets that you haven't sold? Well, that's sitting on inventory on your balance sheet. And when we get into, and I think it's on my next slide, when we get into inventory, we'll explain a little bit more about how inventory can be measured, and you can keep track of your inventory in this way. So the purpose of finding cost of goods sold is to calculate a true cost of the merchandise sold. So you might also hear it referred to as a variable cost. So it means that you sold this, you bought this, this is what's left. It's related, and it's variable based on what you sell. It's in proportion to what you sold. And it doesn't necessarily include your cash outlay, because you may have purchased more inventory because you're getting a better deal, or you don't want to run out of inventory because you can't really predict what your sales are going to be. So it helps management investors monitor the performance of the business. And if inventory is properly recorded and costed out by what's sold, it also monitors how much stock of an asset you have. It helps control the cost of purchases, because sometimes it might be cheaper for you to buy a larger quantity rather than to just buy on demand. And it helps you control whether or not inventory is walking out. You know exactly what you should have in stock. It's a key performance indicator that you're monitoring what they call your inventory turns. And again, we'll get into those details when we talk more about the balance sheet and the assets. Most accounting systems, if you properly set them up and you're using inventory properly, will automatically do this calculation for you. It's not something that you have to figure out how to do. If your system is set up properly, this will happen automatically. And monitoring the cost of goods is the first step in making sure your business is viable and profitable at this point before covering any other costs. So if you've got a good gross profit, now well, I know I have money to pay my rent and payroll and all those other things. But before we get to that part, we'll talk about profit margin. It's that amount that I was showing you before on the last slide. It's the net profit divided by the revenue. It's going to tell you what that profit margin percentage is. And again, you can look at this is a link showing you where you could go and get this little calculator. but it gives you a good idea of understanding, how much money you're making. And it can help you also. There's other calculators there that will show you how to do your markups if you're trying to do specific markups on your products. Again, making sure you're making money and you're not just spinning your wheels providing something that you're not really making enough money on to be in a viable business. So the next section that comes up is all the other expenses, more or less expenses that are a little more fixed for the most part. They're not necessarily related directly to the sales of the specific products or services you're offering. So the first section that I usually see listed, and everybody does this part a little bit differently, but is what is the cost to sell what I've got? So when I say selling expenses, it's going to be those marketing, advertising, promotion, the website maintenance, SEO, all those things that are necessary to get the word out there that you have this product for sale. It could be trade shows, it could be printed materials, business cards, any of those types of things are what you would consider selling expenses. The next big, and that's probably one of the biggest areas of expenses, by the way. So it's kind of in order of what's the biggest, and generally selling expenses is a pretty big expense. Payroll, payroll for staff. Now that includes a lot of different things. It could also, to a certain extent, have some contractors in there, even though they're not paid through a payroll system. You might have 1099 contractors in here as well. But this is payroll for staff, not including labor if you're in a manufacturing. But with staff, you have to pay your FICA payroll taxes. You may have to pay unemployment taxes to your state. You may have to pay workers' comp, which is under benefits, health insurance, and 401k contributions. Some of these costs are elective. You don't necessarily have to give them to your employees, but many employers, as time goes on and their businesses become more profitable, if they want to keep good employees and good staff, these are the types of rewards that are available, and somebody in your company should understand that this is those things, that it's not just the paycheck, it's all the other benefits that are provided, could make or break getting some really good and retaining some good employees. Other expenses, of course, you're going to have business insurance. You may have property, you may have business interruption. There could be insurance for liability if you have a product that needs some liability insurance for it. So there's many different types of business insurances that you should bear in mind that you need to have when you run a business to protect yourself. Rent, don't forget those are utilities. Some rents do include utilities, some don't. So again, it depends on what business you're in. It's highly likely you're going to have some sort of license fees to be in business. There's going to be professional fees, such as my fees with accounting, or legal fees, or any other kind of professionals that you may need to use their services for. Your office supplies and expenses, telephone, computer, internet, repairs. Oh, I have office supplies there twice, I see. Taxes, so there may be some local taxes that you have to pay for the operation of the business. Vehicle expenses, and there's many, many others. It just really depends on what kind of business you're in. And this could be a separate topic all in itself. And there are a lot of business expenses that I would cover more from a tax perspective in a way, because there are many expenses that you can actually put through your business. And I would cover that as a separate topic where we would touch more on the tax benefits as well that are available. So with that, what does an increase in operating expenses mean? And these are what we call more, as I said before, a fixed cost. Rent is going to be rent unless you expand your business. It will always be the same every month, no matter how much you sell or how little you sell. Okay. So of course, an increase is going to be less profit for your business because it's going to impact. So if you hire more people than you need, you're going to have more expenses than maybe your sales. You might have to consider, well, do I really need all these people, or do I need to be paying this much? Or maybe you're making more money and you need to hire more people. Those are the kinds of things that you can monitor when you're looking at your operating expenses. And as this says, a senior management may try to reduce some operating expenses by outsourcing areas of the business. It might be less than hiring somebody. For instance, again, services like what I provide, instead of having a full-time controller or CFO in the company, it might be cheaper, at least for a while, to have it outsourced and pay a lot less money, but yet get the same sort of experience and services. These days you have existing staff working from home. So consider, do I really need that office space? So, you can cut down on physical space needed. And there are other money saving techniques that are available, like automating parts of a business and reducing salaries of new hires. Whoops. So here's another important part, that maybe every single expense you have, you don't pay for upfront and you get some credit on your business. So you might have some vendor bills, which again means that you're not necessarily paying everything right away. You may have some terms. So it is important, and this is very crucial that I see with, again, young businesses, is, hey, make sure that you're recording those bills on time. Don't be late on putting those bills in. And when you see that, you're going to have your expense show up on your income statement, but the cash isn't out. So on your balance sheet, you're going to have something called accounts payable until that bill is paid. So again, those are your liabilities. So you're always looking at your cash, but you always have to take in consideration, hey, I have $20,000 worth of cash. Let me go take some cash out. Well, wait a minute. I have $18,000 worth of payables I have to pay. So consider that you've got current liabilities that may need to be met with that cash before saying, oh, there's all this money in the kitty, I can start taking some out. So, always take in consideration what you owe. I cannot stress enough to have a separate operating account for your business. Do not commingle your personal expenses. Do not take personal expenses out of your business account. Now, I know a lot of times people do that, or maybe there's some accidentals that happen, and that's fine. There are ways that your accountant can put those expenses to the side and have you either reimburse them back, or vice versa. If you pay for something that should have been paid by the company can pay you as reimbursement. But it's just much cleaner and easier. And definitely, if you ever have an audit, it is much nicer and much cleaner and much more credible to show that you are running your business like it's a business, with a business account and a business credit card. These should only be used for the business. So the next set of expenses that you might hear about or come along or see is something called depreciation and amortization. Yeah, fancy words. So these are non-cash transactions. And again, it's something that would affect your profit and loss, but not necessarily show up as a cash transaction. So what is depreciation? It's the covering the cost of an asset over a period of time. So when you purchase something, let's say it is a desk, okay, or 10 desks. Well, the IRS says that, first of all, that's a fixed asset. It is a tangible asset that will be used over a period of time. It allows you to calculate that expense over the use of that asset. So if that desk is going to last you for 7 years, you get to take 1/7 of that desk cost over a 7-year period of time. So it's split over the life value of the asset. So what happens is depreciation expenses recorded on your income statement. Accumulated depreciation is on your balance sheet as what they call a contra account, or a negative account to the asset. So it's also showing that the asset is decreasing in value. So if you bought all those desks for $10,000 and we depreciated $1,000 this year, the value of those desks on your balance sheet is $9,000, and $1,000 expense is taken off of your income statement. When we get to the balance sheet and to the cash flows, we'll explain how that all works in a little more detail and how that puzzle all fits together. But I just want you to know that, again, I'm stressing that when you get to the bottom of that income statement, it doesn't necessarily mean that the amount that you show as net income is the amount that is the cash in your bank account. So There's some examples. Computers are 3 years, vehicles, residential buildings could be 27.5 years, and commercial buildings are 39 years. So these vary. These are some of the IRS rules that are out there, and also generally accepted accounting principles. You'll hear GAAP. Most of the time, most companies use what they call straight line depreciation. When you get into tax, there's also some other benefits where you don't necessarily have to depreciate things over a long period of time. There's something called a Section 179 deduction that you can take. But again, that's more tax, and I'm trying to keep this more regular accounting, simplified. Another thing to take into consideration is, what do you call a fixed asset? What's that number value? These days, anything over around $2,500, again, depending on the size of your company. If you have a multi-million-dollar company, you may only put fixed assets in if it's $10,000. So there is a bit of arbitrary decision-making and what makes sense depending on the size of your company, and what the asset is as far as how long you're going to depreciate it. So amortization is the other side of it. Amortization is something that covers an intangible asset. So I think many times you may have heard, when a business is purchased, that there's something called goodwill. And people don't really always understand what that means. The other intangible assets out there are patents or trademarks, or things that aren't real, aren't tangible. I shouldn't say real, because they are real, but they aren't tangible. But there's a value to them. So the way goodwill works is that, let's say that you are selling your business for $100,000, and you have assets that are depreciated down to, let's say, $50,000, and you have some accounts receivable and everything. When you add it all up, is worth about $75,000 on your books, on your balance sheet. But you're getting $100,000 for your company. That $25,000 is the value of those clients, or that system that you put into place, or whatever that you're selling. That's goodwill. And goodwill can be amortized over 40 years. That was the old methodology. However, I think that things have become a little more updated, and the IRS generally is recognizing 15 years. But again, that's for tax purposes, and there are many different variations of how goodwill is amortized. It's back to, if you bought a company, how long is that customer list really good for, based on you being in the company? So, if you're a dentist and you bought somebody's company and they have, 500 clients, and the goodwill cost is $25,000, well, the goodwill is there for, maybe 1, 2, 3 years. But after 3 years, you've been there. People know who you are now. Those clients are coming back for you, not based on the fact that they came there for the original owner. So that's kind of an idea of how goodwill works. Okay. So, again, this is something that you might want to speak to a tax or accounting professional if it comes up, but I just wanted to give you a little idea of, it is an asset on your books. You do expense it the same way over a period of time, over the life value of the asset, and the accumulated amortization goes against that on the balance sheet. So there's also things called non-operating expenses, really, that have nothing to do with the operation of the business in and of itself. It's not related to the company's core operations, and they're not in this calculation called EBITDA or EBITDA. That's earnings before tax and interest, or you'll hear earnings before tax, interest, and depreciation and amortization. That's EBITDA. It's the operating profit of a company. So what are some of those? It's interest expense, losses due to the disposable or sales of assets, or gains. It could be gains too. It could be money coming in. It could be interest income on, if you take extra money from the company and invest it in some sort of investment, business relocation expenses, lawsuits you may have to pay out, obsolete inventory you have to write off. Those are all not really directly related to the operation or the core of what the company does. So those kind of go below the line. We don't want to skew the operating profit of the company. So the bottom line is calculated as this. It's sales minus the cost of goods, the selling and marketing expenses, general and administrative, operating expenses, depreciation, amortization, taxes, interest. It's a useful number for investors to assess how much revenue exceeds expenses. It's your indicator of your company's profitability. And that can also be written as a percentage, as we'll see in the next slide, that you can use as a benchmark against other companies that are in your industry. You can see what other people are doing and how are you operating versus other companies. And it's helpful to know, hey, you know, that company may be spending more on marketing than I am, or maybe I'm spending not enough, or, you know, maybe my payroll's too high, or maybe my payroll's too low. You know, you can have an idea to calculate, you know, how are you doing? Again, it's a report card. KPIs are very important to pay attention to. So here's a little example I put together. As you can see, it is a period ending on this particular date. It's accumulated. It's all that was sold during this month. It's not a point in time necessarily. It's accumulated over a period of a month. Here's your income, your cost of goods sold, and this is what we call your gross profit or profit margin of 29%. Your cost of goods is related to directly, you know, what was produced or what you're selling. Then you have all your other expenses that we talked about, with depreciation being a non-cash expense. And then you have your net income, which again can be written as a percentage. Now, note there of course can be many other expenses and income items here, but I do want to stress that this is not necessarily the cash that's left. And when we get to cash flow, we'll show you how that gets plugged in to cash flow, but it should match you know, what you have in the equity section, as I was explaining a little bit on the last training that we did on your balance sheet. So if this net income is not below retained earnings on your balance sheet, if it's not the same, then you've got an accounting error somewhere in your system. All right. So with that, you know, I think that kind of covers everything that we were speaking about with income statements. I hope you enjoyed. I hope you learned. I hope this was really quite informative to you. So with that, I will go ahead and end, and I hope you have a great evening, and I will be here next week to speak about the next topic. Thank you.